A lot of things to cover today. And so I want to start with CPI, but I said it's most likely going to come in at 3.1. And that's exactly what it came in at, 3.1. So this is the January barometer from Stock Traders Almanac. And the criteria they use are three components. One is the Santa rally. The second component is the first 5 trading days. And then the third component is the full month of January. Hello, folks. Dan Bird here with ORaaT. Hello, ORaaT Nation. Today is Wednesday, December 13th, and this is the midweek update for the week. A lot of things to cover today, and I'm just going to do one video, so I want to try to get it done pretty quick. So let me share my screen real quick, and we'll see what happened. Today was the Fed meeting. Yesterday was CPI. So I want to start with CPI, since that came in yesterday. And as I said on Sunday, my expectation was for CPI to come in at expectation, possibly the same as last month, which was 3.2, but I said it's most likely going to come in at 3.1. And that's exactly what it came in at, 3.1. And the reason I said that was because this is the 12-month rolling window. So this was the one that just rolled off in yesterday's report, very small increase. So when you get a small increase that rolls off, then you don't get a big decline in the CPI number unless commodities go down dramatically. And they did go down, not as dramatically as they are now, but they did go down. So that's why I thought it would be around 3.1. I definitely did not believe it would be below 3. The next one, if you'll look at what next month's looks like, it's even less than this past one. So that means there's even a lower rate of change or increase that's going to drop off in the January report, which means that potentially CPI will come in the same and maybe even higher. It might go back to 3.2. Depending on what commodities do, and I'll show you that here in a second. Commodities, even after this one was for last month, but commodities are dropping off a cliff right now. So I'll show you that in a second. But look at the one here. This will be reported in February. That is a huge increase right there that's going to drop off in the report for February. That is the first opportunity we probably will have to go below 3%. As long as gas and oil and the other commodities cooperate into January, the February report, which will be reported for January, has a big one that drops off. So that's the first time we may actually get below 3%. Now, the Fed had their meeting today. They held rates steady as everyone expected. It was a very dovish report. The expectation from the Fed was 80 basis point decrease in rates next year. They didn't say when, but 80 basis point decrease next year. That's their expectation, and that probably will happen. The big question is, when will it happen? But just keep an eye on this one. I mean, the next one next month, we may not even get a lower, we could even get a higher CPI potentially. So it might go back to 3.2. That could be enough for the Fed to say, we're going to do one more rate hike. I don't think that they will unless something really dramatic happens with all of these things. But I think they will continue to say, we'll watch it and see what happens. So now let's take a look at the Fed rate hikes and recessions. No, that's not the one I want to show you. I want to show you Fed rate hikes right here. This is from my website, which I'll talk about in a second. So here's today's 0%. So we are now higher for longer is now 3 months. You can see, look at the commodities right here. First of all, the shaded area is for the report that just came out yesterday. And you can see CRB, which is all these things, agriculture, energy, metals. These dropped dramatically last month. Copper went up, but oil and gas kind of went sideways a little bit, but oil dropped dramatically last month. So these contributed to the CPI going down, but only by 0.1%, even though that 12-month rolling window didn't drop very much off. So because of the commodities went down, that's why I said we might get a little bit of a drop to 3.1. Now, look what happens next month. So far, as long as this continues, look at the CRB, even copper is heading down. These are all dropping off of a cliff. So this period right here, we're just about halfway through it right now. This is what next month's CPI will be reported on. And if these continue to drop like this and they don't spike back up, and we'll look at this before the CPI next month, even with that very small one dropping off the 12-month window, we still could get a drop or even at least static CPI. I don't think it'll go below 3, but I think we could get a 3 number, 3.0, 3.1, something like that. And then the one after it is when we'll get below 3. So that's what I'm saying for CPI and for Fed rate hikes. Let's take a look at gold real quick. Gold was heading lower. It went up there and actually hit this high point right here. So if you can see that, it goes back right here to 2020. That's when gold hit this high. It went up and touched it here, pulled back down, and then went up and touched it again. So we'll see if maybe gold can actually break through right there. What else? Let's look at earnings real quick. By the way, this is all on my website. So if anybody's interested, if you want to get my free newsletter, I'll talk about some of these things this weekend in the newsletter. But just go to this website, breakpointtrading.net. You can click on this to get the free newsletter. Most of this content that I'm showing you now is a subscription, but it's not very much. But all of these charts are in there, and you don't need a subscription to stock charts in order to see most of them. Bonds, we'll look at that. Bonds are continuing to go higher. So bonds will move higher as the 10-year yields. Here's the 10-year yield right here. We'll take a closer look at that in a second. But as the 10-year yield continues to move down, bonds continue to move up. I think bonds are going to be the place to be next year. And I think they'll continue to go up and hit highs again. Speaking of highs, let's take a look at the S&P. Back on the home page, you'll get these little charts down here. So the S&P right now, it broke through 4,600 dramatically. And today had a huge day up. There's the March high right there. We're about 3% away from the all-time high for the S&P. And I've been saying all year that we will be getting back to the all-time high. And I still believe that we will do that. But take a look at the Dow. The Dow has already hit and exceeded. So today is now a new all-time high for the Dow. And in fact, if I go back here to the charts section and look at the Dow here on a 3-year weekly chart, this would, oh, I'm sorry, that's the Russell 2000, which, by the way, is also making a big comeback. I'm going to talk about that in a second. But if I look at the Dow right here on a 3-week chart, there's the all-time high back here. And look what happened today. This is actually a weekly chart, so this is the whole week. But look at that. It is now it closed today at an all-time high. So I've been saying since the beginning of the year, the market will get back to all-time highs. The Dow is already there. So now we've got the S&P and the NASDAQ, hopefully going to catch up here soon. By the way, the Russell 2000 has been trading in this range right here, but I think it's getting ready to break out of that range. We've had really good breadth lately. So not only is the Magnificent Seven putting in new highs and continuing to go up there, they're actually starting to pull back a little bit, frankly. But money, I think, now is rotating into small caps. So I've grouped a lot of these charts now. So they're economic charts, sentiment charts, and breadth charts. So if we look at breadth right here, this breadth analysis, there's the S&P. It's not at all-time highs yet, but it's very close. 48.18 is the all-time high. We closed today at 47.07. So there's only 100 points to go. But here's the NASDAQ 100. Here's the New York Stock Exchange. NASDAQ's already broken out. These are advanced decline lines. So these are advancers versus decliners. New York Stock Exchange is getting back to its high. Large cap is already broken out. Mid cap is getting very close to breaking out, and small cap is following right behind. So I think small cap is going to start catching up, and small cap stocks might be the place to be here for the rest of this year and probably into next year. Now, one thing I also added here, which we'll keep track of, is the Santa rally. This is last year's Santa rally. So this is the January barometer from Stock Traders Almanac. And the criteria they use are 3 components. One is the Santa rally, which this year will start on December 22nd. So that's a week from Friday. Last year was up slightly. The second component is the first 5 trading days. Last year was up 1.4%. And then the third component is the full month of January, which was up 6.1%. Whenever all 3 of these things happen, the markets usually end higher than where they began. So a week from Friday is when the new Santa rally will start. And I will put a chart in here for 2024. So we can track that through January and see if we can hit all 3 of those criteria again. Now, on the point of 2023 and 2024, there was a question last week on Sunday on what the presidential cycle means for the market. And Stock Traders Almanac has done a lot of research on this. The dashed lines right here, this is the market for December. Next week, I'll put one in for January, but you can see right here, the market right now, we're right here in the middle of this week. Market's already taken off. So I think this little bump right here that usually starts next week, I think has already started. And I think we're going to continue to the end of the year. But look at the difference between the dashed lines and the solid lines. So the dashed lines are the pre-election year. That's this year. The 3rd year of a presidential cycle is usually the best year in the stock market. The 4th year is also a good year. And in fact, I have the statistics for that. If I can find them right here. So this is Investopedia. So you can just look up presidential cycles and it will explain all of this. But you can see here the year after the election and the 2nd year are the worst 2 years typically. The 3rd year, which is the one that we're just ending, is the best year of a presidential cycle. The 4th year is also a good year, but not as good as the 3rd year. So 4th year, we may go sideways a little bit and then up, or we may go up in the beginning and then down as a potential recession. We may not even get a recession. But if the Fed starts lowering rates, that's the time when the market will probably start pulling back dramatically as soon as the first rate cut starts. But the 4th year of a presidential cycle is normally very good as well. The 4th year of an incumbent president who is running for re-election usually is a very good year. If it is a mixed field, in other words, it's not an incumbent president and you've got people from both parties running, it's usually not as good in the 4th year. It still usually ends up higher, but usually not as good as the 4th year of an incumbent. So keep that in mind as well. So we'll see what happens, but that's the presidential cycle. What else do we have here? Something that I added down here at the bottom is the bias matrix for these Magnificent 7 stocks. So this is a short-term, mid-term, and long-term bias. These are all the Magnificent 7 plus 4 extra ones that I threw in that usually get a lot of attention. Oracle reported this week, so they went down. If any of these change in the day that I post it, I'll put a box around it so you'll see which ones have changed. Nothing changed today. This is the same as it was yesterday. This is today's report, though. But in any of these, you can go up and take a look at the actual chart. So if I want to look at Tesla, Tesla was selling off this morning, right until the Fed meeting. And they had a really nice comeback right at the end of the day. There's Tesla right there. There's a better view of it. So Tesla sold off in the morning, went below its 50-day moving average and came roaring back. So a lot of the Magnificent 7 look like that. So they did well with the Fed meeting. There's Amazon actually breaking out right now. So that's good news for the Magnificent 7. Same thing over here on the market bias matrix. I post this every day, and it basically shows short-term, medium-term, and long-term bias. This long-term, by the way, these are the top 3 indexes, S&P, NASDAQ, and Dow. Whenever these turn red, that means it is a death cross. And whenever they first turn green, then it is a golden cross, which all 3 of them are in right now. And you can see overall, this divides the indexes, sectors, industry groups, intermarket relationships, commodities, metals, and currencies. And it shows you the bullish and bearish biases of each for short-term, medium-term, and long-term. And all of them are green right now. Down here, I track it over about a 2-month period. And you can see how red and yellow things were a couple of months ago and how much greener everything is today. In fact, yesterday they turned yellow as the market kind of started to sell off a little bit. And today these 2 ended up green, and this one might turn green tomorrow. And the chart over here. So you can see the orange is short-term, gray is medium-term, yellow is long-term, and this is the overall up here at the top. So it gives you a sense over time what these look like, and you can tell the short-term usually changes first, medium-term changes next, and then the long-term follows behind. So all of these are moving sideways, which is very bullish for the market right now. So this is a great way just to watch, and you can see here which ones have changed today. So interestingly, the S&P regional banks today just turned bullish for the long term. Regional banks have been doing really well. There's the chart where this pink line crossed the blue. That was the short term change. Where the blue crosses the red right here, that is the medium term change. And then where the red crosses the gray, so it's a 50-day crossing the 200-day, that is the long term. So if you watch this each day and see what happens on a short-term basis, you can catch these runs early in the cycle. So this is the intermarket relationships. This is the NASDAQ versus the S&P. The S&P actually was outperforming the NASDAQ up until today. And today that changed. So today the NASDAQ just started to outperform the S&P. The other ones that changed today, actually only one other one changed today, which is gold miners turned from bearish to bullish. So gold miners had a nice run, really nice run today. So they just changed. So they might be one place to take a look. Gold is still bearish on the short term, but if you look at the gold chart, it just turned bearish just a couple of days ago, and it actually sold off today, interestingly. So miners are actually doing better than the gold itself, but that's one to keep an eye on. This is a great way to get into some areas ahead of the market when things first change. Especially watch these sectors right here. So when these sectors first change, I think one of these just changed recently. Let's take a look at healthcare. Healthcare's had a great run. You can see it turned short-term bullish middle of November, and now it's medium-term right there at the end of November, and long-term bullish in the middle of December. And it had a great day today, so it took off as well. So this is a great way just to watch this and see when these boxes appear. That's when the short-term, especially the short-term basis, maybe help you understand or see places to get into. What else do I have? PPI. PPI was reported yesterday. It came in a little bit weak as well. Here's the PPI chart. So you can see it's kind of had a little spike a couple of months ago, and now it's pulled back down. And the 3-month rate of change is dropping dramatically as well. In fact, it's below 0. So that's actually de-inflation on the PPI in a 3-month period. It's negative right now. So that's what PPI looks like. All of these charts are over here. For you real estate folks, there's a 33-year mortgage rate chart. So this is the mortgage rates right here. It's just above 7%. Hasn't quite broken 7, but it's starting to curl over. And you can see the 10-year treasury down here is dropping dramatically. So I expect the 30-year rates to probably start following that. This actually shows you the 33-year midpoint. So we're actually pretty much in the mid-range of where mortgage rates usually have always been over a 33-year cycle. If we want to look at the 10-year Treasury, look at that. And I said, I actually said a few weeks ago when this pink line crossed the blue line right here, that's the short-term bearish signal. I said then that we were probably headed to 4% on the 10-year yield. And right now we are 4.03%. So in fact, we probably touched, the low was 4.09009. So we almost touched 4% today. And this probably will continue to head lower. So we might be in the high threes on the 10-year here very shortly, which is helping the stock market. That cheaper rates will help the stock market. Now, interestingly, if the Fed does start cutting, and I kind of hope they don't till later in the year, but I don't think it's going to be like some people think they're going to cut early. I don't think they'll cut early. Some people think they're going to keep rates high and not cut at all for the whole year. I don't think that's going to happen either. But when the Fed first starts to cut rates, then that actually might be bad for the economy because people will start to delay taking out loans to make capital purchases and equipment purchases for their businesses because they'll wait for lower rates. So that actually might be a bad thing for the economy. I said this on Sunday, and I'll say it again, and I will continue to say it. The Fed has two mandates. And anytime you hear somebody talking about rate cuts, if it's not followed up in the same sentence by the second mandate, which is unemployment, then they are not giving you full information, or they might not even know. Maybe they don't even realize it. But there is an unemployment chart on here somewhere, if I can find it. Oh, it's down here, recession watch. Here's the unemployment chart. So the Fed will continue to keep rates high as long as the economy is doing well, which it is. You can't have a recession with 3.7% unemployment. You can't have a recession with positive GDP. As long as that unemployment rate stays low, the Fed will continue to keep rates where they are. They probably won't raise, but they won't cut either. So when will they start cutting? Well, they'll start. This is the thing to watch is unemployment, not anything else. Not a recession will be a result of unemployment. So the unemployment's going to happen first. So watch this chart. If unemployment gets up to 4.5, if it gets up in this range, and normally what happens when unemployment starts, this is the SOM rule. Recessions start when the 3-month moving average, which is the pink line, rises by more than 0.5 points above the 12-month average, which is currently is 3.5%. So if it gets up to 4% and keeps rising above that, what normally happens with unemployment is it snowballs from there. So it keeps rising dramatically and much faster once that 0.5% rise starts to happen. So when it gets above 4% and it gets close to 4.5%, that's when it might actually start taking off much faster. That's when the Fed will start cutting. That is what they will be looking at, their second mandate. They will pivot from inflation, which they have not pivoted from inflation. They might have pivoted from raising rates, but they haven't pivoted from inflation yet. But as soon as the unemployment rate gets up here too high, then they will stop talking about inflation and they'll start talking about the jobless rate, and that's when they'll start cutting. That's what I think anyway. But I expect that's going to be probably sometime late second quarter, sometime in the summer next year is when you might see the first rate cut. And then watch out. That first rate cut, I think the market's going to continue going higher into January. I think we're going to have some bumpy rides after January, kind of going sideways. And then in the summertime, if all of this starts to happen and a recession potentially is looming, then the Fed will start cutting. And after that first rate cut, I would be out or go short because the market will probably sell off for a while, but then it will bounce back at the end of the year, near the election, by the way. So watch out for that. Anyway, that's all I got for today. Hope everyone is doing well. I think that's everything that I had on my list of things to look at. We can actually real quick, just out of curiosity, take a look at gold on a shorter term basis. rather than that long-term one that I showed you. So here's gold just over the last month. You can see it's just went up here and hit 2150, closed, hit at 2150 and came all the way back down to 2050. So 100 points in one day right here. And then once it came back down, it's starting to sell off again. So keep a watch on gold. That 2150 is a really key point. If you go back, if we go back 3 years, for instance, you know, there's that one candle right there for a weekly. Gold might still continue to sell off some more before it starts back up again. So keep a watch on that. Anyway, that's it. Hope everyone's doing well. If you're interested in my newsletter, just come to breakpointtrading.net. You can click on this button right here and get the free newsletter. I publish it every Saturday, usually. If you want to see what earnings are coming out, you can click here. And I like to look at S&P 500. So Adobe's coming up, Costco's coming up, actually tomorrow. Adobe was today. Actually, they've already reported. Just out of curiosity, let's see what Adobe is looking like. Let's go down here and see what they're doing after hours. Oh, down $40. So Adobe must have missed. So down big time, down 6.5%. It's down $40 for Adobe. But that's one way where you can see what earnings are coming up. Just click on that button and then you can sort it by whatever you want. If you want to see small cap stocks, there's some of the small cap ones that are coming up, etc. NASDAQ 100. There's Costco, Micron, Paychex. So just a quick way to see what's coming. All right, that's it, folks. Hope everyone's doing well. And we will hopefully be back with Mr. Zuber on Sunday, and we can talk about all of the CPI and the Fed and all of those conversations. He and I often will disagree on where we think CPI is going to be. So could be an interesting conversation on Sunday. Anyway, that's it. Hope everyone's doing well, and I'll talk to you soon.